Afternoon, Tony and Vaughan. We're here for the October market update. How are you both?
Great.
Jordan, good to see you again.
Good to
Yeah,
be here in October with you, Jordan.
second time
Take,
around, we're good to go.
you did well, mate. Well, you did
Thank
well.
you.
You remembered the month this time. Well done.
Yeah, I only have like 2 lines, so it's good I get it right. Just going over market and economic update. So interest rates, the RBA has paused rate changes for now, but inflation remains sticky, particularly in services. Slower path to rate cuts is expected in Australia and a little bit in the US. Labour markets, the job market is loosening, except for highly skilled sectors, suggesting a slower wage growth ahead. The US economy remains resilient, but potential government shutdowns, geopolitical risks, and AI driven spending are shaping market sentiment. And inflation and correction risk, ongoing inflation, private credit risk, and geopolitical events could create short term volatility, but the medium term growth picture remains intact. Do you guys
Yeah,
have
so
any?
I think the main change there really is that the domestic rate cuts seem to be slowing down a little bit to what the market was pricing in. So I think now there's only about a 30% chance of a rate cut priced in for the November meeting here. However, there's still another fourth of the rate cuts expected in the US. So we're a little bit ahead of them in terms of bringing interest rates back. But that can change, of course. So that's what the market's priced in now, and the expectations of further rate cuts in the US are one of the factors that are really driving the US tech shares, and the Nasdaq has just bounced all this line. It continues to, and that's part of it. Some companies that are leveraged have some rate cuts priced in, and therefore the stocks are moving. So. That domestically, I think, it's probably taken a little bit of a surprise that rate cuts are slowing down. We don't necessarily think it's the worst thing, though.
No, I think also to add to that, Vaughan, is one of the things we're discussing in our meeting this morning was the fact that even in respect to the jobs numbers, if you actually have a look at it, a lot of those jobs or new jobs are in the public service sector or companies that rely on their income from the public service sectors. There seems to be a lot of government-funded employment just at the moment, rather than the private sector as well. So that was actually really interesting. I think that was also Ray brought out after the last RBA meeting as well. When I was reading that, and I thought that was very interesting.
Mm. And the private credit point, Tony, that's something we've been discussing and you've been particularly concerned about. In
Yeah,
terms of what's happening in the space at the moment, there's a lot of transparency and valuation issues that we see.
oh, absolutely. I mean, there's the large private credit. We saw Latrobe get smacked a bit recently, Latrobe Financial by ASIC in respect to their product determination. So, and there's a lot of underlying risk with some of the high interest rates, but there's a lot of the smaller credit funds out there globally. I mean, there's $18 trillion, I think, globally in private credit at the moment. So there's a lot of companies, the larger ones that, are funding loans to companies. But it's the ones that are backing real estate or even locally here where you have, brokers, not stockbrokers, but mortgage brokers who are offering without any disclosure or transparency, like 6 month, 18% loans, which that means there's probably 25 or 26% being charged to the clients. And why somebody, got that as a distressed asset. And it's mind blowing that, I mean, when you have an unregulated sector, that this can actually be done. And it scares me because, I saw it during the GFC, and as I was discussing this morning, I've still got a few scars from the GFC. They especially come out in the summer when you have a bit of sun. But I think the key is, though, it's prime for a disaster to occur, and that's the thing that concerns me. Is you've got a lot of people out there have no lending experience going and raising money from people who aren't sophisticated investors and don't know where the money's going, and how are these people getting paid monthly? Basically, I hate to say it, but some of them sound like a bit of a Ponzi scheme to me as well. So I'm really concerned by that sector.
And some of the potential investors that are going to be impacted are really retail mums and dads who have an SMSF and might put a couple of $100,000 into a private credit scheme like this.
Yeah, you know,
for the long
somebody's just guaranteed you a 20% 6 month return, and you're going to get paid monthly, and then you get your capital back, and it's against a 60 or 70% LVR property. Well, that's rubbish. I mean, the real valuation on those properties, those properties could be geared to 120, 130%. So even if they're sold, that person is usually carrying a second mortgage, or in some cases even a third mortgage without that real disclosure. Going back to them, it's massive. It's a massive risk to people's life savings. They might only have 400 odd thousand sitting in their super fund, as an example, and just going and
Yeah,
parting with these checks thinking it's guaranteed. It's it's scary. It's really scary. It's a massive bubble, but it's unregulated, and that's the part that concerns me the most. You haven't got licensed advisors selling these. You've got people vested interests who are going and offering it, and that concerns me a lot.
yeah, that's
I think
right.
on the portfolio
John, did you want to talk a bit about the
performance,
portfolios at the moment?
yep, just portfolio performance and positioning. So September performance, overall, it was pretty mixed. Strong, really strong from the Australian equities sleeve in the traditional portfolios. A little bit weaker in the global equities and real assets. Global shares, the underperformance was slightly driven by consumer and financial sectors, as well as concentrated stock positions like Aurora's. The fixed income Australian credit exposure supported the performance, reflecting value in high quality yield assets.
And this September, I mean, we all know that September is historically the weakest of the 12 months of the year. And it looked like it was going to, history was going to repeat itself a week or two into September, but the market's turned a little bit. As you mentioned, a couple of the more concentrated funds, it's slightly underperformed the benchmark. Like Aorus is a good example. I mean, they'll only hold a maximum of 15 stocks at any time. So they're holding about 13 at the moment. So when you have a concentrated fund like that, their 2 or 3 year performance has been exceptional. But with the concentration of the fund, you can have a bad month now and then. But overall, it was actually quite a good month. Particularly if you compare to September's of previous years. And as we touched on earlier, with the way the rate environment is playing out in Australia compared to the US, the small caps in Australia have actually been outperforming the larger caps of late. So we've been catching a little bit of that through some of the funds like AQLT, which was a change we made in the portfolio must have been about 4 months ago now, 4 or 5 months ago, that we sold out of DNR Capital, their Oz Equities High Conviction Fund, and we brought in AQLT, and that's continued to be a really positive move. So we've captured a little bit more of the market. It's a less concentrated fund, but also at quite a lower cost as well. So that's been a really positive one. And we are still monitoring the Australian equity sleeve just to make sure we're getting the best of the smaller cap environment. And so we are looking at making a change actually, which we'll go through in the next day or two with the Blackwattle Fund.
Yeah, and I think also too the Blackwattle Fund, if you actually had a look at its underlying holdings, and it actually matches really well with AQLT because there's no real correlation. So as an example, it has a high exposure to the materials sector, which is good in this market from a mid-caps perspective, especially with things like gold prices or precious metal prices very high at the moment in general. And then if you actually have a look at, but only I think 3 or 4% exposure to financials. And if you have a look at the beta shares one, you've got, I think a 46% exposure. So virtually the inverse, 46 and about a 5% exposure to the materials sector. So from that perspective, they're actually a good match because they're a bit of a blend which even each other out in some way. And neither of them have suffered because of lack of exposure in financials or lack of exposure in materials. Both of them have performed really well.
Yeah, that's right. And so in the initial instance, the first trade that we will be doing with Evergreen will be implementing the Blackwattle Fund, but funding it from the defensive side of the portfolio. So we'll go a little bit more risk on, and then we're also reviewing some of the other Oz equity funds as well to see if there's some more changes. So we'll just start with a 3% allocation in the Blackwattle Fund to have a little bit more Australian small and mid cap exposure, and then potentially look to increase that over time. Yeah, that's probably the one main change that we've been looking at the moment, because there's a lot of factors that suggest that small and mid cap segment of the market is going to continue to have a bit of a run. And of course, we're seeing other alternative assets like gold, of course, has continued to run. I think that the 1 year on gold has been about 100%. I think it is.
No, the 1 year on pure gold, I think, has been 52%, but the 1 year on the gold miners fund with VanEck has actually been 100%.
Yeah, that's right. Yeah. So that's
two different risks, of course. So you've got one which is a gold miner, which is very capital intensive, has to get the stuff out of the ground, but with gold prices so high, obviously, there's lots of gold coming out of the ground at the moment as well. Yep. Very cyclical from that perspective, but quite good. I think from an international perspective, we are looking at a few options at the moment as well, but no decisions have been made as of yet. But some good potential options moving forward there as well.
Yeah, I think we've just got a bit of an eye on some of the staples of our portfolio that have just been so good to us for so long. But just reevaluating whether the market conditions over this next period are still going to be suitable. So funds like Moat, for example, which those sort of companies that are in the Moat index are typically going to perform well in times of volatility, higher rates, less, a lower interest rate environment that's benefiting geared companies doesn't necessarily have the same positive impact on companies that have really strong cash flow and no debt on a relative basis. So,
and I think our exposure and patience with L1 Capital, as per every year, seems to work. You have 6 months of underperformance, scratching your head, saying, what are they doing? Then 6 months where they blow the market out of the water. And I think I was looking today, their long short fund, which our 3 non-ESG funds all have exposure to. I think it was 28% for the 12 months versus 13.7 for the 12 months for the ASX 200 index. But if you had a look at a 6 month period prior to that, they were virtually nothing versus the index, so which was about positive 5 or 6 for that 6 months. So, yeah, so it's as per my experience with L1 for about the last 8 years, my personal experience, just patience with them. You always know that they're going to shoot out the water one part of the year. That always happens, and they've done it again this year.
Yeah, that's right. And they don't care so much about what the benchmark's doing. And also
totally benchmark unaware. Yep.
Thanks, guys. Appreciate it.
Thank you, Jordan. Thank you, Vaughn.
Hey, thanks, Jordan.
Say, gents.
The Kofkin Bond Market Update is a product from Kofkin Bond and Company, which we are an authorized representative of Count Financial. All information in this market update is for education and entertainment purposes only. It is not intended as a substitute for professional, finance, legal, or tax advice. The hosts of the Kofkin Bond Market Update are not aware of your personal financial circumstances. Before making any financial decision, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from the market update. For more information, head to the disclaimer page on the Kofkin Bond website, or you can find resources on the ASIC website and find a registered financial professional near you. In the spirit of reconciliation, Kofkin Bond and Cohers and the hosts of the Kofkin Bond Market Update acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past,